All right. Okay, so we're here with Tatiana, and we are going to be talking about FHA loans versus conventional loans and getting some clarification on how that works. So welcome, Tatiana. Let's dive into this.
Hi guys, thank you for inviting me. Yeah, so I have my handy dandy PowerPoint presentation
Yay.
for conventional versus FHA. So let's take a look. Can you see it?
Yep, we see it.
Okay, perfect. So let's chat about what it is. Conventional loans, they're not insured or guaranteed by federal government. They are following guidelines set by Fannie Mae and Freddie Mac. And Fannie Mae and Freddie Mac are companies that were created to provide the mortgages. So quick reminder about my previous video about Fannie and Freddie. Bank has certain amount of money to lend, right? They have to replenish their funds. They do the loans, they close the loans, and then they package them and sell them on secondary market to Fannie and Freddie. And then, they start all over again. So when a loan gets sold, it has to follow the guidelines of the whoever buys the loan. So Fannie and Freddie, they set the guidelines, bank has to follow them. Conventional financing, minimum down payment required is 3% if person is first-time home buyer. If a person is not a first-time home buyer, but the income is below 80% of median income in the area, they still can do 3% down. Otherwise, they would have to put 5% down. Conventional has private mortgage insurance, and it's required when the down payment is less than 20%. The private mortgage insurance is provided by a private mortgage insurance company, and the cost of it could vary depending on the credit score, depending on the loan amount, the down payment amount. Basically, the lower the down payment, riskier the riskier the loan is for the bank, and they want to be insured, and the insurance is more expensive. If your credit score is lower than 700 or starting at 740 and below, then it's gonna have impact on the premium, because it's kind of like when you have a car loan, right? And you get in car insurance, and they look at your driving history, and if you had DUI, your premium is gonna skyrocket. Kind of the same concept here. When your credit score is below 700 or 680 and below, it's equivalent to sort of like bunch of speeding tickets or DUI, and then the payment is gonna go up drastically. So the FHA, in contrary, is insured by government, is insured by Federal Housing Administration, FHA, which is part of U.S. Department of Housing and Urban Development, short for HUD. So the FHA is more lenient on credit issues, and they do have mortgage insurance, just like conventional, but the mortgage insurance is set for that. It's fixed. It's a percentage of the loan amount, and it doesn't matter what your credit score is, you're gonna have exactly the same premium. The down payment is 3.5%. The difference between conventional FHA with the mortgage insurance is also that the mortgage insurance cannot be removed on FHA. I forgot to mention on conventional, it can be removed once you reach 20% equity in the property. On FHA, it stays there for the full duration of the loan, unless later you refinance into conventional finance.
Can I ask you a quick question? Hopefully I won't throw you off track here. So on the conventional loan, I think I've seen, and if I haven't, you can stop me there, but I think I've seen where you get your mortgage insurance and that mortgage insurance has a predetermined amount of time and then it's going to automatically fall off based on what the market conditions are. If you get that mortgage insurance with that predetermined amount of time, and for some reason the market declines and therefore the property doesn't hit that 20% equity, does the mortgage insurance stay on? Is there like a fine print in that agreement where the mortgage insurance would stay on because there's not 20% equity, or does it still come off?
Yeah, so the mortgage insurance on conventional comes off once you reach 20% equity in the house. So
Okay.
just for simple example, you bought a house for 100,000. Now your loan amount is 80. You have 20% equity. The mortgage insurance can be removed.
Okay.
And they count it based on the original sales price. They don't analyze that price maybe went down to 90,000, then you need to wait longer. No, they count it based on 100,000. However, if price goes up, the value goes up, and you might hit the 20% equity sooner.
Right.
All you need to do is contact the lender, tell them, I believe, I have 20% equity in the house.
Yeah.
In most cases, they'll order appraisal to confirm that the value went up. And if you're in good standing with them, you're not late on payments or anything like that, then they'll just, typically they agree to remove that mortgage insurance.
Okay.
Yeah.
All right. That makes sense. Okay. So it's based on the original sales price. It's not based on current home value unless that value goes up.
Right.
Exactly.
Got it. Okay. Perfect. Thank you.
Yeah, so going back on conventional versus FHA. FHA has better interest rates. That's another difference between conventional and FHA. The government programs like FHA or VA, they do have better rates than conventional.
Okay.
So I do have an example here. Let's just, as we were talking about difference in mortgage insurance, right? So conventional versus FHA, we have 660 rate and the price is 500,000 and we do 3.5% down payment. That's minimum required on FHA financing. Conventional loan, and this is actually a rate based on rates of November 10th.
Okay.
A little bit older slide, but concept is the same. 7.5% rate, principal and interest, 33.74 plus mortgage insurance. That's on conventional, 462. Remember, I mentioned it's kind of like having a DUI, so your mortgage insurance is pretty significant
because of that low credit score, or because of the 660 credit score. That's
because of the
a little bit higher.
Yeah, the riskier you are, you have to pay more.
Yeah.
Right?
Okay.
Exactly. So 38.36 is the payment, and FHA is at about 7% interest rate, and the mortgage insurance is $220. More than twice lower, and the payment is $34.83. So in this case, it makes sense for a borrower to go with an FHA loan, even though the mortgage insurance will stay there for the duration of the loan. At some point, like everyone else, like typically we refinance when rates drop, and they can refinance off to conventional financing.
Okay. Makes sense. Okay.
So there's another example when if the credit score is 740, and you can see that premium on conventional goes down to $185 from what, 460 right on the previous slide. Also on conventional, there is option of avoiding monthly mortgage insurance. It's maybe story for the a different topic, but there is an option like that as well. Then the payment is going to be $35.59 or $33.74. When with FHA, it's still gonna stay at $220, and the total payment is $34.83. So in this situation, it's important to talk to your consultant and look at both options and analyze what makes more sense for you.
Yeah. Okay. All right, yeah, and again, as we almost say every time we're talking, it's like talk to your lender because they need to look at your individual situation to determine what the best path for you is. And that's one of the things that's great about Tatiana is she will she deep dives with people and works with them.
All options, right? And things with overlays and what you're able to offer, that changes sometimes too, right? It's not like it's fixed across the board all time.
Yeah.
Isn't that right?
Exactly. So the overlay is basically when bank adds some additional restrictions to borrower's profile, so to say, than Fannie or Freddie and HUD would do, right? So, for example, the Fannie says 620 is minimum score. The bank says we put in overlay and we're making it 640. That's why it's important. Like if you get denied for a loan, double check is that bank's overlay or it's actual agency guideline, and it's going to be the same throughout the industry. Prosperity home mortgage, we do follow Fannie and Freddie guidelines and HUD, so we don't really have overlays. We have a process of getting exceptions. We would contact Fannie, Freddie, HUD directly for particular situation and ask them, here's the situation, would you give us exception? Would you allow us to close this deal? And if they say yes, then we go ahead and do that.
Okay.
Yeah. Okay.
Yeah, very good.
Yeah. Awesome. All right. Thank you for clarifying that. Really appreciate it.
No problem.
All right. And if anybody needs to get in touch with you, how do they find you?
571-245-3000. I'm available all the time.
All right, very good.
That's right. And she is too.
Yeah, she is, absolutely. All right. Well, thank you so much, and we will see you on the next video.
Thank you, guys. See you.
Bye.